Hello everyone, welcome to our discussion about cost accounting, chapter 1, particularly the value chain. So this course builds on information that you learned and skills you gained in accounting 160 and 161 previous to this course. So we're going to build on that, add to that in a way that will hopefully make it even more valuable to you. And so we're going to focus on cost accounting, which is really the question as how much things cost when we produce them, all right? And how to measure that, how to capture that, and be able to communicate it to decision-making people, those that are in management positions in the company. That's why it's called managerial accounting, is it's geared to those who are making management decisions. So managerial accounting may be a little broader term than cost accounting, which is focused on the production cost of the item that we're producing. Typically manufacturing, but we'll also look at many examples of services and other types of businesses as we go along. But to start out, we want to talk about the concept that we did not necessarily visit with early on in your earlier accounting class, and that's the idea of a value chain. And however, it does get a lot of attention in, you might say, the press. You might have heard this term, value chain. And I want you to think about it in terms, let's try to put it in terms you can relate to. There are certain things that you as a consumer go to the store and purchase, and other things that you need that you actually make yourself, okay? So when you're making the decision between whether you make it or you go to the store and buy it, all right, you are making a judgment as to whether there is value to you buying it, paying money, more money, in almost every case, than making it yourself, okay, at least in terms of what's out of pocket. Is there value there? That's what we're talking about when we talk about value chain. So for instance, if you go to a restaurant, you have made a decision that what that you buy there has value worth the additional, what the price is you're going to pay. Now, to get the food there at the restaurant, lots of things had to have happened that if you made it at home, you might do some of those steps yourself. But even if you make something at home, you probably have to buy ingredients, right? And so all of those pieces, all the way from if you're going to make bread, from growing the wheat to harvesting the wheat to packaging it in so that it can be transported, all of those things are part of that value chain. And that allows you to get to the point where you're willing to go to the store and pay $3 a loaf for that bread. Now you could decide to make it and your value chain changes a little bit because you're adding the value at home. You're still buying ingredients which still have their own value chain, if you will. Because if you go buy honey, unless you raise the bees yourself, somebody else produced that honey that went into your bread, or the yeast, or the flour. Okay, so there's been a lot of attention about the part of the value chain which we sometimes refer to as supply chain. A lot of problems with that this past few months, and a lot of attention on making sure that there are no, you might say, bad actors in the supply chain, meaning you're not buying stuff that was made with child labor or forced labor or was illegally mined or any of those types of things. all part of that value chain, okay, that goes into making the product that you have valuable. And companies are deciding which part of the value chain to be part of. Can they provide? And see, the real key is, can they provide more value to me as a consumer, or you as a consumer, than it costs them to do what they do? So if they raise the grain to make your bread, can they raise it and sell that grain to the next step in the value chain for enough additional value to cover their costs and make a profit? If they can't, they should probably change their outlook, change something about that process. Okay? So when we think of a value chain, it's a very long process for many things, many products, and they can be, in fact, in some cases, it's years. This next slide talks about, from a business standpoint, a integrated business, one that is involved with a big chunk of the value chain. This starts as early as coming up with a new idea in research and development, looking at what we can do and what might be a new product. For instance, a new car. Electric cars are a new thing that there's lots of research and development going into to try to make them truly efficient and able to perform in a way that we want them to. Okay? And very closely aligned with that is the design. That's really, how do we make it? Okay, we can research and development, come up with great ideas, but can we actually make it, manufacture it? Can we come up with a vaccine, research and development, but how do we go about actually being able to make it in large quantities? And then, of course, once we know how we're going to make it, then we have to buy, and that's what we talk about, the supply chain, the stuff that goes into making it. So before that, all those purchases are made, we had to know what we were making, how we're going to make it, and then purchasing, and we're going to buy things, and of course, we're going to perceive value there, right? We're in that, those items that we purchase that are going to go into our product. They're going to be assembled parts, you might say, or ingredients, or all of those things. And of course, that can be very complex for certain products. You think about all the parts and pieces that go into an automobile or something like that. That's a huge list. All right, that is a value that I perceive, because if I wanted to make that car, I would have to literally gather all those parts myself. So I see value in a car manufacturer making sure that all the parts are in, getting them all shipped in, and where they need to be assembled. Then, of course, there's just the production, which is sometimes what we focus on, and sometimes we don't spend enough time on some of these other pieces of the value chain. And then if we don't tell people about it, they're not going to know that there's value. So there is value in marketing and matching customers up with the things they actually need, which is what real good marketing is consumer wants and needs matched up with a product, all right, and being able to tell them the story that's going to solve their problem or make their life better. And then distribution, get it to that customer, which of course we know is a huge issue, and we spent a lot of time talking about Amazon, and we see delivery trucks and that distribution channel, part of that value chain, because otherwise I got to go somewhere and pick it up, all right? And that takes my time. So is there a value to having it dropped on my doorstep? And what am I willing to pay for that? Okay, that value. And then for many products, but not all, there's a customer service component, a follow-up from the company that tells that I value, that I want them to check in, to respond to my questions. If there's a problem with it, that they're going to follow up and give me the satisfaction on that. That can be perceived. So all along this, we could have things that are what value added activities, things that actually the customer perceives as having value. And an efficient company is going to try to reduce the types of activities that don't add value. Let me give you an example. I would perceive value in getting the products, the parts for the car to the factory. That's valuable, value-added product, or a piece of the product, or the chain. But once they're in there, the fact that they move them around 15 different times to different locations with using a forklift, I, as a customer, don't care. That is, in my opinion and in my perception, not value added. It does not add anything to my experience. It does not something that I am willing to pay more for. And so you want to understand customers and understand what they are willing to pay more for and what they are not. And those that they are not, and again, you have to make some generalizations, some averages, okay? Then you try to reduce them to as little as possible. Some still have to happen. I don't perceive value in paying my employees' payroll. I don't. If one company makes a product and they do a great job of payroll, and another one does a product and do a lousy job of payroll, I don't need to, sense of value to pay more for that. Okay. So I don't, but it's still got to happen. You can't just say, oh, we're not going to pay our people because our customer doesn't perceive value. But certain things we can find a way to reduce. We certainly want to be as efficient as possible in paying our payroll, not fancy, not, do it in a way that we spend too much money. So we're talking about cost accounting, as we talked about. Remember, and that's that idea that you have to be able to do your part of the value chain with the value being higher than what it costs you to do that activity. So that's why it's important that we can get reports on what the cost is, okay? And our focus is different than financial accounting, which you learned in Accounting 150 and 151, and maybe intermediate accounting if you had that class. Okay, this is about what things cost during the process. How much costs are they consuming? So the primary purpose for financial accounting is to give information on a big picture of the company. Can they successfully, in all areas of the value chain, okay, that they're operating in, are they able to generate enough value, charge customers more than what it costs them? Okay? And we have lots of rules. We have international rules. We have those rules in the United States, because this is being communicated externally to users who are going to make investment decisions, who trust that information to make those investment decisions. And therefore, we need to have some assurance, some way to check it, audit it, and that requires some standards. That requires rules, because there's nothing to check something against if there are no rules. Cost accounting doesn't need to apply those rules, doesn't need to follow those rules, has very few rules, has some kind of general good ideas, some better ways to do things, but not rules in the same sense. Okay? Because now there's a relationship. They're not completely separate, because remember, ultimately, financial accounting is saying, can I generate value for a cost that's less than what the value was? Now, it's always in a big picture. Now, cost accounting is probably going to break that into 100 different little pieces to see if this piece of the value chain we are actually producing a value that covers is more than the cost. Okay? Because we're managerial accounting, we're making that decision. Maybe we'll stop doing this aspect and we'll pay someone else to do it because they do a better job of that value chain activity. Okay? And they can do it more efficiently than we can, and therefore we'll pay them instead of doing it ourselves. That kind of decision is based on smaller pieces of a cost accounting. But ultimately, the same model applies. The same ability to create value is critical for both. And so there is overlap, there is sharing of information, there are shared skills and things, but there is some very real differences between the two kind of approaches. So depending on what information or decision you're making, you'll need different kind of information. So part of managerial accounting in today's world, there's almost always more information than you can use because we have such a proliferation of computer information and stuff, data we can get. And the key thing sometimes is being able to find in all of this data the right information for the decision we need to make, and it's in a way that we can trust it, okay? Because not all of that data is of equal value and equal importance. And that's part of what our judgment is. What we try to learn a little bit more in this class is how to determine which is the more valuable information and how to report that to our managers, to our bosses, to whoever is making the ultimate decisions as we start off. And then ultimately, as we move up the chain in the organization, decisions we will ourselves be making. Individuals may make it. We may see our performance. Okay? We need that in a system-based way so that it's easy to find and can be trusted. All right? We evaluate our workers, our managers, all of that type of thing. Internally. Remember, this is still an internal process. So sometimes we will make this, differentiation. This is a cost that's good to consider for decision making, and some other costs may be better for control, meaning what we're using to evaluate at a worker. Okay? For instance, the idea that, okay, we have to cover the cost of our product when we decide whether or not we're going to make that product or whether we're going to sell, how much we're going to sell that product for. But if we are evaluating a manager who only has a control over a part of that product process, then it doesn't make any sense to use costs that they can't control, right? They are going to be very frustrated if their evaluation is based on something they have no control over. So we need to be careful with that. We identify which kind of costs can be controlled by that particular manager, especially in that control and evaluation process, because that is so, it has so many, you might say, difficulties, because it's the human element of you're deciding whether someone is doing a good job or not, and that's very personal and very difficult to do. Okay, so what data do we need depends on what decision we need to make. So let's see a couple of examples, you might say. Okay, the AM Bakery has been making and selling baked goods through a small store. How about a food truck? All right, during some times when maybe we're off, or maybe to cater to a particular target audience that we can get our product to closer by rather than trying to lure them to our bakery. Seems to be a very popular thing. Food trucks seem to be everywhere. Should we expand? Should we do that? And of course, underlying that, should we do that instead of our bakery, or should we do it on top of the bakery, or what? That sort of thing. All right. So as we look at our costs of running the bakery, there are certain things that are going to be higher if we have a second location, a mobile location in this case, but a second location. Utilities, if you consider gas and other things to run the truck and things like that, there'll be additional costs there based on having another distribution channel, the food truck, or another location, if you will. Okay? You will probably need to have some additional costs to bring people to that food truck that you wouldn't have had if you didn't have the food truck. Okay? Now, stuff like labor and ingredients those costs are going to be driven or going to go up or down based on not necessarily how many locations you have, okay, but how many products you make, how many items you produce. Obviously, if you're going to make croissants, okay, how much flour or how much butter or whatever you need is going to depend on how many croissants you make. Now, of course, you'll have some that will get scrapped, all that kind of thing. So it may not be a perfect one-to-one relationship, but you can see the relationship between how many people you have working and how much flour you have to buy and how many items you're making, which we would hope would go up if we have the food truck. Okay, so it's still going to be increased, we hope, by the food truck, but it's really the additional croissants we're making that are actually driving the cost. Because adding the food truck, if nothing happens to the number of croissants we make or sold, then our ingredients and labor wouldn't necessarily increase. So, important definition, differential costs. So when we use that term, differential, sometimes the term is used incremental, it means that something that's different depending on our course of action. So we have 2 choices, maybe 3 choices, could be 100 choices, whatever. And the costs are different between choosing A versus choosing B. Okay? If it's the cost is the same, for instance, the rent on our original bakery is the same whether we continue to do the bakery or add the truck, right? If we continue to only do the bakery, we still have to pay rent. If we decide to do the bakery and the truck, we're still paying rent. So that is not a differential cost. It is the same regardless of how much we our choice. Revenues, of course, are the additional income or inflows because of our choice. All right. So if we offer the food truck, then we hope there will be additional revenues. At least that would be our plan. That would then line up with those additional costs. Okay? So what we really ultimately are looking at is how much revenues are going to go up versus how much costs are going to go up. Again, can we provide value that is worth, that we can charge our customers for, that covers our costs? So you might set up a particular, decision, and this is the kind of thing that we'll do in our homework for chapter 1, okay, is to look at status quo and the alternative side by side, and then compare the difference. So we see that, we do anticipate there will be differential revenues by adding the food truck, which is going to bring in, to make more, we'll have more ingredients, more labor, and then we'll have that increased utilities. Rent, like we said, is going to be the same. So there is no difference. It's not differential. But we'll spend some more on marketing. And then of course, there's the costs that are unique to just the truck. and that is lease and say repairs or fuel or whatever to operate the truck. And so you see that we ultimately project here an increase in operating profits of $1,790. Okay, so we have them two side by side, but really what we're focused on is the difference. Okay, does this make us more revenue compared to more costs that are going to happen? So when there's a manager or an individual, okay, who's accountable for a particular, the food truck, let's say, or the bakery by itself, that's called a responsibility center. They have a responsibility. They are being evaluated based on performance of that particular piece of our business. All right? So we have, if we think at a bigger scale, all right, for this bakery, we have two, you might say, divisions, bakery and food trucks. Now we're talking about maybe a larger expansion where we can actually have someone who supervises the food truck process and someone who supervises the bakery. And each of them has a responsibility, okay, for their piece. And so we look at and break out, when we can, as much as possible, the cost and revenue responsible for the person in charge of food trucks and the cost and revenue, okay, responsible for, the person responsible for bakery. So that when we evaluate them, we are trying to look at them on what they are actually responsible for. That's their responsibility. Things like general administrative for the whole company, that becomes kind of off to the side and is not generally used to evaluate the responsibility. We'll get into more detail about how we would differentiate between those that are general costs and those that are specifics in a later chapter. So, a couple of things that they did in this one, okay? The channel manager salary is included in the particular responsibility center. But the president's salary, okay, is not. It's in part of that general, okay? All right? So that's the idea that that president is supervising all of it, and therefore it's not really any responsibility of the responsibility manager to be able, he can't do anything about the president's salary. So they shouldn't be used to evaluate them. Now, another way that we use costs especially to evaluate, and we will have a chapter later on budgets, okay, is we project and then we compare the actual. So this budget is on the right or the middle of this three columns here. Actual on the left. There's no magic formula as to which one you put on the left or right. Okay, but what we're looking at is a comparison. And here's the idea in business: you're expecting things to happen the way the budget says. So your focus is on those things that are way out of line with what is budgeted. All right, and we will spend a lot of time talking about how to hone in on those differences in later chapters. But this is an important process. Project what you think is going to happen, what you expect to happen, see what actually happened, and then evaluate where did we go wrong. Maybe it was our estimate that was so far off that we should have not made it now that we know better. Or maybe we are actually not being as efficient or good as we'd like to. We're not creating value in quite the same way as we anticipated. All right, so these next slides just kind of show you how cost accounting can be incorporated in every aspect of the business, every aspect of the value chain. Okay, so even when you start out coming up with new ideas, okay, you can do that with the term lean manufacturing. That is the idea of trying to reduce waste at every step of the process. Okay, So we, early on, even when we're designing a product, we work with those, because when we're doing research and development, we are coming up with what ingredients, what pieces need to go into our product. And even at that point, we're already communicating with our very good suppliers, those that are very efficient, okay, to be able and shown that they are able to do things at a low cost right up the front. We partner with them even when we're in the process of research and development, okay? When we design how we're going to make it, okay, we've identified the activities. We get rid of those non-value added activities, okay? We design it to be more efficiently made. Meaning, yes, we could manufacture it this way or we could manufacture it this way, but this one will allow us to do the same thing with less parts or less processes or something like that. And if we think about that even up front, not to sacrifice quality, not to sacrifice what's valued by our customer, but to actually do what the customer values, but at a greater efficiency and reduced cost. When we buy stuff, we do the same thing, okay? Maybe we buy things in bulk. Maybe we buy things just when we need it. Maybe we are very closely aligned with our supply chain so that they know when we need it so they can anticipate and they can be efficient, all right? We may measure how many defects come in and from a particular supplier, and if there's too many defects, we go to them and say we need to renegotiate this contract or we need to find another supplier. Okay, you're not reaching our level of value here, so we can't afford to pay you for those defects. Production is probably the easiest way to think of it. We try to make sure that everything is worked at a very efficient level, okay? Often we need input from those that are actually on the manufacturing floor. Even as accountants, we need to get out, we need to talk to folks that are actually making it. Chances are they have some great ideas about how to do things better, faster, more efficiently, with less waste, perhaps. Okay? We can target our most important customers, the ones that are making us the most profit, who perceive the most value in our product. Okay? We may use, in this example, some form of coupon or free services or free things to order as part of our marketing effort. Okay, that may be the most efficient because it gives them the ability to, rather than going out and blasting to the world and trying to find new customers, maybe we find that it's less cost to really pull in our existing customers and sell them additional products. Distribution, do we use somebody else or do we use our own trucks, things like that? Okay. How do we get it there? And of course, companies with the price of fuel right now are very interested in being able to reduce distribution costs, meaning that more than one thing is coming to you rather than individual distribution, that sort of thing. Even in customer service, we're measuring how well we can provide. And of course, you've probably sensed this, and maybe many of the easy customer service questions are automated, meaning you don't talk to a person because they can do that very quickly. That makes sense because the simple questions you want to be able to just take care of quickly and easily with no. The problem that I see is that they're losing value because there's nobody that's really well versed in the next level of questions, okay, to answer those. But that's another discussion, okay? Sometimes they rely too heavily on the automated things, and therefore I don't perceive as much value in their customer service. Some ways that companies are trying to incorporate all this. You may have heard the term ERP, Enterprise Resource Planning. Okay, they have software that literally gets involved in each of these pieces and actually can track our products all the way through the value chain, our people, our what we're buying, what we're utilizing. It's very comprehensive software. Costs millions of dollars in many cases, but can really identify good things and bad things in our value chain. Okay, some key players, just some terminology you might come across as far as the people. Treasurer is a term that doesn't get used a lot very often. Most of the time that treasurer, except in very large companies or maybe in a nonprofit or something like that where they tend to use that term treasurer, that's not often. Most of the time the CFO absorbs the treasurer type responsibilities, meaning managing liquid assets, which is basically how much bank money we got in the bank and moving it around to get more interest and stuff. Interest rates have been so low for so long that it's very little value in moving your money around to different banks and things like that. Okay, controller is much more a common. That is a kind of oversees the accounting function. All right, internal auditor is important, and then probably where you would start if you got a degree would be cost accountant of some level or another. Okay, and you can move up that and become senior and that sort of thing as you gain more experience. All right, these last slides kind of reviewed some ethical issues, okay, or ethical principles that apply to accountants, specifically managerial accountants. Remember, they're internal. They don't have the same tax or audit rules that come into play for CPAs. Now, CPAs can be these type of managerial accountants, but they don't need to be often, and they actually have their own certification, CMA, that can be used. Okay, so again, we want to be able to trust the data internally, even though external investors aren't going to see it. We still need to be able to trust it. We still need to have integrity. Okay, so some guidelines. If there's something that you don't feel is right, discuss it with your immediate supervisor unless they're involved. Clarify that. You can talk to a hotline, go outside to a disinterested party. Okay, remember you have a confidentiality issue. You can't just go blabbing about it to just anybody outside your organization. Okay, you may need to talk to an attorney. You may need to go over the head of your supervisor. All right, perhaps even to CEO, to the board of directors if it is serious enough or involves other people. Okay, these are the things we consider to be key to having the good information internally, and they sound very much like the same things we would want from an accountant outside, as an outside accountant providing financial statements for investors. Okay, competence. We need to be, have the training that's necessary. We have to keep things confidential. We can't just tell everybody what our company's doing or how much money they're making, all that type of thing, or what somebody makes as salary. Integrity, making sure we're true to ourselves and what we know to be right. All right, so competence is about knowing what is right. Integrity is being true to that. Okay, and credibility is just how we communicate it so that people can believe us. Are you believable? All right, and of course, credibility comes over time, right? If you constantly are telling something that's only partially true, you lose credibility. So these are some details, you might say, of what you consider to be competent. All right. We have to provide whatever rules or standards we have, even though there aren't many in managerial accounting. We do our best to identify and abide by those. And if there is something that we don't understand or don't have the expertise on, then we need to get our butts in gear and get the expertise, or we need to actually make that clear. Say, I'm not comfortable with that kind of analysis. I've never done that before. How do we go about making sure that I do this in a way that's competent? Confidential. Okay, we've talked about that. Don't, especially that last one, sharing it for unethical or advantage. Okay, when you go to another company, if you change jobs, sharing information that was confidential from the other one so that you have an unfair advantage in the new business is not ethical, according to this code of conduct. Integrity. This is probably the core thing. Okay, you need to do it. Nothing that's going to discredit the profession, nothing that's going to make people doubt your honesty. Okay, and that means some communication, especially with conflicts of interest, because you work for the company, right? So there is an inherent conflict of interest in that you don't want to say, find bad things. You want to find good things, and if there comes across something, you may have to stand up and do it despite that conflict of interest. And then finally, just being fair, objective, making sure that you communicate that to others. If you're going to be late, if there's not enough information, we don't gloss over that. We keep digging, okay? Or we say there's not enough information. There's not enough data. The data we have some issues. We're going to have to wait for additional data. We need to be willing to do that, even if it makes us look, at least temporarily bad. All right, that's our summary of Chapter 1. Hopefully that will help you in your review of the reading and being able to apply it to homework problems and be able to feel comfortable that you have a grasp in that.